Hi guys, welcome back to my channel, Kelvin here. So it's been a while since I last showed you my portfolio and a few of you guys have been asking to see it. There's a term for it. What is it called? Yes, kaypoh. But Lim Pei like your idea. That's why in this video, I'll show you my portfolio. But it will be pointless if I just do that. It's not just a le koala kind of video. You came here for three things. First, to look at my portfolio. Second, to laugh at it. And third, to learn from it. I will also be discussing what's my new investing philosophy because my portfolio has evolved yet again since my last portfolio video 3 months ago. There's a lot to talk about, so let's start right now. Before I show you my portfolio, let's talk about a potential crash. And in one of my previous videos, where I look like I have a very bad headache in the thumbnail, I told you guys that a crash might be coming. But of course, it was just a fun prediction and not an advice to be taken seriously. No one knows whether a crash is coming or not, and anyone who tells you that they know is lying. Many e-commerce sites predicted that there will be a mega sale on September 9. And just so happens, many stocks went on sale that day. Is it just me? Or is it all Illuminati? And right now, with all the warnings that another crash might be coming, you must be feeling like a kid tied to a kite flying around without control. Basically, that's how investors feel, up and down every day. But just remember this, in the long term, as long as you buy and hold good companies, you will be alright. If you are planning to sell just because a crash is coming, here's Uncle Roger reacting to you.
Hiya, you f***ed up.
Instead of panic selling, just keep calm and invest on. So with that being said, I will now show you what you came here for. My first stock is DBS. I have 200 stocks at an average price of $21.86. Now, some of you will notice that the price of the stock is actually lower than my average price of $21.86. But how come my returns are positive? It's because DBS is a dividend stock, so the total returns includes dividends received. Now, here's the special part about dividend stocks. As long as you hold it, you will receive dividends. But why is it so important? That's because for a non-dividend paying stock, like maybe Tesla, the price needs to go up for me to earn money. If it crashes like it did last week, I will lose money. But for a dividend stock like DBS, I'm actually immune to price fluctuations. The price goes up, I receive dividends. The price goes down, I receive dividends also. And that's the beauty of owning dividend stocks. A market crash doesn't really affect my income in any way. I'm just like that dog sitting in a room with fire, saying this is fine. Recently, Musk has asked Singapore banks to limit their dividend payouts to conserve cash. But I wouldn't worry too much about that because Singapore is an important financial hub. Banks will still be around as long as Singapore is around. Eventually, this will all pass and you will see dividends going up again. Next, I have the 3 REITs. Ascendas, Mapletree Industrial, Mapletree Logistics. Right now, they are giving me about 3.6% dividend on average. Their prices have gone up quite a bit this past few months. That's why their dividend yields are slightly lower than DBS. But like I said, price movements doesn't affect me in any way because I earn from dividends, not by selling dividend stocks. However, what's important for a dividend stock is that the dividends must increase over the long term. It's like if you work at a job, you need to get pay raise every few years, right? For example, Mapletree Logistics dividends has been increasing almost every year. Same for Mapletree Industrial. And Ascendas, even though there's a dip this year, over the long term, dividends are expected to increase. And that's the reason why I sold First REITs and Fraser Logistics even though they have a very high dividend yield. Their dividends can't increase consistently and that makes them a bad dividend stock in my opinion. Anyway, Ascendas, Mapletree Logistics and Mapletree Industrial are very good REITs. Their management has been consistently acquiring new assets to improve the revenue all the time. So I'll be continuing to hold these REITs. Next, I have sold off UOB. Here's why. If you look at a side-by-side comparison between the 3 banks in Singapore, DBS, UOB and OCBC, you will notice that they have a really high correlation with one another. All 3 will move up and go down together. And their dividends are really similar too. I'm not so sure about the future, but as of right now, as I'm already holding DBS, I find it pointless to hold UOB also. So I've sold it. If that being said, if you feel that you need diversification, owning 3 banks is a good idea too. Next, I have sold off Mapletree Commercial Trust. I feel that the REIT's performance is not as strong as compared to all the other REITs that I have. First, they did not acquire new assets as much as other REITs. And second, their shopping mall, VivoCity, had been impacted quite a bit by the pandemic. When people can't go to malls to buy Pao Cha, of course the revenue will drop. As we can see, VivoCity net property income has dropped quite a bit due to rental rebates. In the long term, I still believe that Mapletree Commercial will do well. But rather than wait for it to recover, I decided to sell it off and move my money elsewhere where I will earn a much better return. I have also sold off Capital Mall Trust and Mapletree North Asia Commercial Trust for the same reasons. When people can't go shopping and shop outlets are forced to close, shopping mall REITs will be affected. They will recover only when a vaccine is finally out. But who knows when? End of this year? Next year? Or next year? Nobody knows. Rather than wait for them to recover, my money can earn a much better return somewhere else. That's why I have sold them. Okay, that's all for my Singapore stocks. Next, I have overseas stocks. The first one is SSLK, a United States technology ETF. I have 20 stocks at an average price of $50.69. The reason I own this ETF is because I believe that tech will be very relevant in our lives in the future. If you look all around you, like you will realize that tech is everywhere. From waking up, going to work itself, buying groceries, online shopping, everything is tech, and it will only get better from here on. Speaking of technology, I also own ARK. ARK ETFs all follow one theme: disruptive innovation, which is just technology that can disrupt the way we do things. For example, in the past we have steam engines, railways, internal combustion engines, telephone, cars, electric, then computers and internet. With every invention, our lives have changed for the better. So that's what ARK ETF is about, investing in future technologies. ARK has 5 ETFs: ARK-K, ARK-Q Autonomous Tech and Robotics ETF, ARK-W Next Generation Internet ETF, ARK-G Genomic Revolution ETF, and ARK-F FinTech Innovation ETF. When you take the top companies from the bottom 4 ETF and you combine them all into one ETF, you get ARK-K. It has a bit of e-commerce, some genomics, autonomous tech. It's kind of like Power Rangers where you combine all the dinosaurs to form the Megazord. The reason I have ARK-K is because I want to be invested in everything. And by the way, that's called Kiasu. I also own ARK-W, Next Generation Internet ETF. It's basically a group of internet-related companies that are innovative, like Tesla, Facebook, Spotify, Sea, Tencent, Amazon, and so on. Next, I have Square, 25 stocks at average $145.62. Square allows small businesses to accept credit card payments, track sales and inventory. And because Square knows all the financials of the business, they can provide loans quickly to small businesses when they need it, helping them to accelerate their growth. Square also allows users to send and receive money, like our Paylah and PayNow system. The reason I bought this stock is because the company has been growing steadily and is looking to disrupt the financial sector in a big way. Finally, I have Tesla. I hold 121 stocks. My average price $260.74 after the 5-to-1 split. I wish the price is before the split. This stock needs no introduction, with its wild daily swings, futuristic car, and Iron Man boss. But there's something I want to quickly talk about. Many people have told me that Tesla is very overvalued. And yes, you are right. However, if you take into account all the things Tesla will do in the future, you will understand why it is so-called overvalued. Here are a few points. Number 1. Competition. Tesla is so far ahead of everyone that no one is anywhere close to it. For example, in April, they achieved 3 billion autonomous miles, while its nearest competitor, Waymo, only achieved 20 million miles. This is really huge because this means that Tesla will remain the leader of autonomous electric cars for a very long time. Second, full self-driving. When Tesla finally achieves full self-driving, it will be able to create a fleet of robotaxis to drive people around. That means that the entire taxi industry will be disrupted. Third, Tesla App Store. When people no longer need to focus on the road, it will free up time to play games, do work, watch movies, all in their car. The App Store will be a whole new industry on its own. There are so many more, like insurance, solar roofs, new battery tech, new product lines, and so on. If you want to know more about Tesla, you can check out Chicken Genius Singapore. He gives weekly updates on Tesla and is super bullish on the company too. If you have watched my previous portfolio videos, you will notice that I no longer have IWDA, EIMI, and Illumina. That's because I now prefer ARK ETFs and Tesla more. So I have sold them all and redeployed the cash. So that's all for my portfolio update. And by now, some of you will have noticed that my investing strategy has evolved yet again. That's because I'm constantly learning new stuff all the time. Elon Musk has once said this.
You should take the approach that you're wrong. Your goal is to be less wrong.
And that's a very good principle to live by, because if I think that I'm always right, I will never have to improve myself. But if I assume that I'm always wrong, I can take in feedbacks and criticisms, process it, and use it to level up myself even more. And that's why my name is Kelvin Learns Investing, not Kelvin Learn Investing. So every once in a while, I'll look at my portfolio and ask myself, how can I improve my portfolio to bring me closer to my goal? And that goal has always been financial freedom at 42 years old. Basically, to achieve financial freedom, your portfolio must be at least 25 times of your annual expense. That is so-called the 25 times rule. So let's say my money expense is $3,000. I multiply it by 12 months, multiply it by 25 times, then I will get $900,000. What that means is, as long as I can reach $900,000, I'm financially free. So around 3 years ago, I started by buying Singapore dividend stocks, which gives around 4 to 6%, which is pretty good. But then I realized that 4 to 6% is too low if I want to reach 900k in just 10 years. So my portfolio strategy evolved to buying index funds. It gives me stability and gives me a better return than just 4 to 6%. And best of all, I do not have to manage index funds because it auto rebalances itself. After that, my portfolio strategy changed for the third time. I realized that if I buy innovative stocks like Tesla, Square, ARK ETFs, my return can be much higher. So I started buying innovative stocks. Then recently, I realized that if I split my money equally among all the stocks, my returns will be much lower. So my portfolio strategy changed for the fourth time. This time, I decided to concentrate my money in just a few stocks that can give me the best return, so that I can achieve my financial freedom much earlier. That's why you will notice that I'm super duper heavy on Tesla stock. It's more than 60% right now. And I imagine you must be feeling like this. You were the chosen one. What happened to diversification? Yes, you are right. Conventional wisdom will tell you to diversify your investments just in case one stock fails, you still have other stocks to back you up. But Warren Buffett has once said this: wide diversification is only required when investors do not understand what they are doing. That means that if you are not 100% confident that the stock will do well, you will have to diversify your investments. But if you are very confident in a stock, like very confident that it will win, I think that it is alright to concentrate most of your funds in that stock. Let me give you an example. If I give you $100 to bet between Joseph Schooling and Joseph who is still schooling, who will win the swimming competition? Will you bet 50 on Joseph Schooling and 50 on Joseph who is still schooling? Or will you rather all in your money on Joseph Schooling because you think that he has a 99.99% chance of winning? The 0.01% chance is if you got a cramp and Joseph who is still schooling wins. Even Warren Buffett himself does the same thing. If you look at his portfolio right now, the top stock is Apple at 44%, while the rest have only a small percentage. Meanwhile, Chicken Genius also have a very large percentage in Tesla, while some YouTubers basically own 100% of Tesla in their portfolio. Now of course, I'm not telling you to all in your money on Tesla stocks. This is just a strategy that I'm using right now. Will it work for you? Probably, probably not. This strategy is super risky and it will even make you lose money if you use it wrongly. So don't blindly follow me and always do your own research. But is this strategy the best? Personally, I do not know. Tesla may burn and crash in the next few years for all we know. If that happens, I will be a sad PP. But if my plan works out, I will achieve financial freedom in the next 10 years. And that's all for today. Let me know down in the comments below, what are your thoughts? Is my strategy crazy or is it a good strategy? Like, share and subscribe as I'll be posting new videos every Monday. See ya!